Oh, what's up YouTube? How's it going? I'm back again for another random video. I'm going to be talking to you guys about credit scores. So if you're one of those people that like to listen rather than read, bear with me. I got a good video for you guys. I was just curious to know how the credit score system works here in Canada. It might be different all over the world, but you get a credit score of 900 points. And, it's based on excellent, good, or poor. If you had bankruptcy or whatever and you got to build up your credit, it stays on your file for, 7 years or something like that? It's something stupid that you can't get any credit. So if you were bankrupt, that really sucks. I would try not to go that route, but if you're wondering, if you already know what your credit score is, that's called a soft credit check, so you're not going to get shit for doing that. It's not going to affect your score. If you do a hard credit check and you want to apply for other things, that's going to lower your score and lower your points. Depending on what you own and how much shit you pay for all the time, your points go up either slow or fast, so pay your stuff on time. Anyways, without me mumbling and jumbling, I got quite a bit of shit to get through, so I'd like to read this to you if you guys have the time. So sit back, relax, play me, and listen. So I went to greedyrates.ca. You can look it up yourself on the internet. What is a credit score? A credit score is a 3-digit number that allows lenders to determine the potential borrower's credit risk, the risk they run for not paying back their credit cards or loans. Sorry for the echo. I'm in my basement. The walls aren't painted and there's nothing on the walls yet, so it's a little echoey in here. Canadians typically cannot borrow money or receive credit of any kind unless they have a solid credit score. Canada's two national credit bureaus, Equifax and TransUnion, create credit scores and create reports based on the information they receive about each borrower from their lenders. Okay, so here we go. What is a credit score range Canada uses? The credit score operates within 3 to 900. The lower your score, the less likely you are to get approved for a credit card or loan. If you do manage to qualify for a credit card or loan despite a low score, the interest rate you receive will likely be high. Conversely, the higher your credit score, the more likely you are to get approved for a credit card or loan. And the lower the interest rate will likely be. Good credit can also help you rent an apartment, get a better job, get approved for insurance coverage at a lower premium, and get a better plan for your cable, phone, or utilities. Remember that. You can bargain with good credit. Hey, I've been with you guys for 6 years. Come on. Throw me something good. Excellent credit is 741 to 900, so the max. Consumers with excellent credit will likely have no or very few late payments in their credit report, will regularly pay off their balances in full, and will have a low credit utilization across all their lines of credit. Those with excellent credit enjoy rapid approval for their credit card and loan applications, as well as the lowest interest rates available, high credit and loan limits, and access to premium credit card benefits. In other words, all the financial doors are open to Canadians with excellent credit scores, and banks roll out the red carpet to get their business. The median credit score in Canada is 749, which means 50% of the population has excellent credit. So that's good to know. Note that credit score ranges in this article are molded on the Equifax Risk 2.0 scoring model. Designations are subjective and can vary by credit bureau and credit insurer. So a good credit is 690 to 740. Consumers with a credit score in this range still enjoy some of the best financial products and interest rates available. This credit score means you are generally financially responsible. Canadians who sit in this credit score range make most of their payments on time, with only the occasional late payment or rare occasions. Their credit card utilization is pretty low given the amount of credit they have available. Those with scores in this range are unlikely to have difficulty obtaining most credit products and loans. Fair to average is 660 to 689. You still have a lot of credit options at this average credit score Canada evaluation, but borrowers on the lower end of this range will certainly experience higher interest rates from lenders. Those on the mid to low end probably have been late on their payment multiple times to more than one lender and may have defaulted on a loan at some point. Below average is 575 to 659. Borrowers with below average credit will face higher interest rates for the lines of credit they are approved for, which can cost quite a bit of money over time. They also are not eligible for the more lucrative credit cards that provide accelerated levels of cashback and rewards. Poor credit 300 to 574. If this is your credit score range, you unfortunately have a significantly damaged credit history, perhaps the best defaulted on multiple loans. Your debt is very close to your credit limit and you have declared bankruptcy, which stays on your credit report for at least 7 years. In this range, you will have a difficult time obtaining credit or getting approved for a loan. Yikes. While a credit score is a simple shorthand for your credit worthiness, a credit report is a more complete overview of your financial history. It is one of the major tools a lender uses in determining whether or not to give you credit. Contained within your credit report is a key identifying information like your address and social insurance number, your payment history with your creditors and record bankruptcies, or any court judgments that would affect creditworthiness. A list of lenders or other parties that were authorized to look into your credit, and any banking or collections information. So they go way back. They check all your shit to see if you've been a good little boy or girl. Canadians are entitled to one free credit report per year. Well, that's cool. Called Consumer Disclosure from either Equifax or TransUnion. To apply for your free credit report from Equifax by mail and blah blah blah. To receive your free credit report from TransUnion either by mail or online, you can't wait a year, but for your free report from the Credit Bureau. A Canadian financial technology company and credit monitoring service can give you free access to your credit score anytime. I reached out to Borrowell's CEO Andrew Graham to get his thoughts on the value of this new offering. Borrowell has recently launched free credit report monitoring. For the first time, Canadians are able to monitor important information in their Equifax credit report on a monthly basis for free online, said Graham. I use CIBC and they have it on the app that I can check my credit score whenever I want, which is nice. Every 3 months it gets updated. Now more than ever, Canadians should keep a close eye on their credit and personal finances. We were proud to be the first company in Canada to offer consumers free access to their credit scores. This is a logical next step for us to give our users a much deeper look into the overall credit profile. The same data used by many lenders, banks, cell phone providers, and landlords. If you receive your credit report and discover inaccuracies, inconsistencies, incomplete information, or signs of fraud, you can dispute the information with the Credit Bureau. What is a credit rating? A credit rating is a rating listed by some credit reporting agencies. It is an individual rating of each of your credit histories items detailing the type of credit being used and how quickly payments are made. The ratings for each item on your credit history are expressed on a scale of 1 to 9. 1 means you paid your bill within 30 days of its due date, and 9 means you never paid your bill or that you've made a debt payment proposal with the lender. So like, hey, can you extend, I missed a car payment, I'm so sorry, so-and-so bank, can you extend? Boom, that's a hit. They'll do it, but that's a hit on your credit. Hey, sorry I can't pay the rent this month. Your landlord! I'm not sure how that works, but I guess your landlord reports you and yikes, if he was a dick. Along with the number, you will see a letter assigned to each credit rating. The letter stands for the type of credit being used. There's I for installment, a car loan, O for open, a student loan, and R for revolving, a credit card, because money's coming and going, you're putting it back on, right? What factors influence a credit card the most? 10%, the types of credit, payment history is 35%, amounts owed is 30%, length of credit history 15%, new credit 10%, types of credit 10%. So there you go. If you have multiple credit cards, it is actually good. Whether people want to say it's not, it's good to use every credit you get because it just shows that you're using their money and that it's good for you because you're spending it, right? So they're giving you something, use it. I made that mistake when I had when I bought my truck and then it was with a different bank. I chopped up the credit card. I should have just used it once or twice, a year, just to say, hey, new credit's good. There's proof right there, no matter what your parents say. I don't want to hear any arguments in the comments. There are many factors that influence a credit score positively or negatively. Equifax and TransUnion both have slightly different formulas for determining scores, but there are a few shared considerations evaluated above all else. Payment history is 35%. Payment history is the most important factor influencing your credit score. Lenders want to see how likely you are to pay back the credit that you're about to give you. They will figure it out by looking at whether or not you paid back your loans and consumer credit. Your payment history shows all of your consumer debt except for mortgages. It details whether you've paid each debt as agreed, whether payments have been deferred, whether the debt has been paid off entirely, whether payments have been late, or whether you have any payments in collections. Bankruptcy filings and lien lines against you all falls into this category. While the exact number of points that your credit score drops for each of the above infractions is shrouded in secrecy, a general rule is that the higher your credit score is to begin with, the more points you will lose for your poor payment incontinence. However, if your credit score is already low, you won't lose many points from your new negative behavior. For example, if your credit score is 780 and you have your first late payment, your score can drop 90 to 110 points. More than over 30 days late, however, your credit score is 680 and this is your third late payment, your credit score will only drop 60 to 80 points. Similarly, means the credit score falls 140 to 160 points. If your original credit score was 780 but falls only 85 to 105, if your credit score was 680. So yikes. So the more repetitions of you are late on your payment, the less and less you're going to get dinged. I don't know if it's used to you missing your shit or doesn't want to hurt your score that bad. More recent payment history has a greater impact on your score. The more distant payment history has a lesser impact on your score. There's your answer. Credit utilization is 30%. Credit utilization refers to the amount of credit that you are using relative to the amount that is allotted to you. For instance, if you have a credit card with $1,000 and you have a balance of $200 on that card, it's a 20% credit utilization. A well-arranged, regulated rule of thumb is to keep your total credit utilization across all credit products lower than 30%. Length of credit history is 15%. Creditors like to see how you've had credit history for a long time and that you've used credit consistently. Those who have short credit history or haven't regularly used the credit they were allotted is being seen as a greater risk of defaulting on their balances. Boom, there you go. Use your credit cards, people. I use mine as a debit card once in a while if it doesn't charge me too much. Soft and hard credit checks, 10%. A soft check occurs when you check your credit score yourself. Reviews your credit history for non-lending purposes. It does not negatively affect your credit score. A hard check, on the other hand, occurs every time you apply for a credit card or a loan. Having too many hard checks in your credit history during a short period of time can negatively affect your credit score, knocking it 7 to 10 points. A large number of applications for credit products can significantly financially difficulty to your creditors and make them suspect you of credit shopping. So like you're not paying your shit off and you're just shopping for more credit cards. Who knows, right? You want more and more to borrow, but you can't pay off what you owe. That's not good either. Diversity of credit is 10%. Diversity of credit shows lenders how many types of credit products you have in your credit history. The more diverse your credit history, showing a variety of credit types, the better. Credit diversity with payments made on time shows lenders you're responsible for all types of credit, which makes you more apt to lend to you. Total payment ratio. Though not officially part of credit score calculations yet, credit bureaus are now beginning to look at a new factor called the total payment ratio, TPR. TPR has been a consideration on TransUnion credit reports since 2015. Do you generally pay the minimum? Do you generally pay significantly above the minimum? Or do you typically pay off your balance in full? These are the questions that your TPR answers. How much do you pay and how consistently do you pay it? While TPR shows up on TransUnion credit reports, the Globe and Mail has reported that neither credit bureau is as of yet factoring the TPR when calculating credit card scores. Actual credit score, sorry. This may change in the future. So how to increase your credit in Canada? Ugh, so much. Negative information can stay on your credit report for at least 7 years. If you have negative factors in your history, you need to counter them with positive steps towards repairing your score. And there's no time like the present, right? We advise you to stay on focusing on these key steps. Holy moly, there's so much here. Whoops. lost here. Pay your bills consistently and on time. Reduce your credit utilization. I'm just going to scan through this quick because this video is already dragging out. Resist credit inquiries unless absolutely necessary. Correct misinformation and update old information. If you want to know more about this, you can just visit this website. And do not close paid off credit cards right away. That's what I told you, that's what I did. And they go into why you shouldn't. Think of it this way, let's say you have 2 credit cards, each with a $1,000 limit. One has a balance of $500 and the other has a balance of 0. This means you're using $500 out of $2,000 in credit, which works out to a strong 25% utilization, like I was explaining. But the moment you close your $1,000 credit card with a 0 balance, suddenly you're down to a $500 balance on the remaining $1,000 card, which doubles your utilization to 50%. Before closing the paid off credit card, you were well below the recommended card utilization ratio of 30%. But after closing it, you jumped above it. And don't be afraid for a fresh start. And the last thing I'll say is consulting a credit counselor before engaging in bankruptcy proceedings. Such a move can damage your credit for 7 years, and few creditors will lend you during that time. However, if you do take this drastic step, know that this can rebuild your credit with a secured card. This is a credit card requiring an upfront deposit that makes your credit balanced, but still gets reported to credit bureaus to help you reestablish your credit and eventually go back to an uninsured card. There you have it, guys. Wow, that's a lot of stuff to know about your credit. And just to quickly sum this up, I went to go buy my vehicle a few years ago used, and the interest rates are up to 30%. There are some banks out there that if your credit is so terrible, they will lend you 30% interest on a vehicle. Just let that sink in. That is $30 on every $1,000 or something like that. That is insane. So if you owe $10,000 car, 30, 60, 90, 120, that's like $300 extra a month on interest on your payment. You will never pay that off. Do not file for bankruptcy. Do whatever it takes. If you have, I feel sorry. I hope this video was informative to you. Please like and subscribe for more random videos as I try to upload not so often, and we'll keep this channel random. And I'm sure you now know a little bit more about your credit and your credit history and how to build your credit. Take care, guys. Bye for now.